Let's bring in our next guest. Of course, he does join us here. Blackstone, by the way, the largest alternative asset manager, 1.1 trillion assets under management. They own or control as much as 250 companies, 12,000 separate assets in the real estate business. They're the largest private owner of warehouses globally, for example. So, yeah, no shortage of things to discuss with the company's president and COO, Jon Gray, who is here at Post 9. John, thank you for coming down.
It is great to be here. Great to be here live at the stock exchange.
Well, it's great to have you. Listen, you were on not that long ago talking earnings. I'd much rather bring it to what we talk about so often, the macro economy, particularly given some of the stats that I just gave people. You know, in rereading your comments and CEO Steve Schwartzman's comments, I did get a more positive tone from your conference call. I would assume perhaps some others did. Are you starting to see a turn and getting prepared for that when it comes to inflation coming down and the potential, obviously, for rates declining sharply in the near future?
Well, that positivity was about the deal business tied to rates coming down. But I think it's helpful to talk about the economic picture overall. And what I'd say what we see from our companies is that there's been real resilience in the economy. Revenue growth still mid-single digit at our companies. Defaults with our corporate borrowers still extremely low. But we are seeing a bit of slowing out there. We're seeing that sequential revenue growth decline a bit. We're seeing weakness. Employment is pretty flat, I would say. And when we look out there, what we're seeing is definitely weakness in the consumer sector in particular, water parks, theme parks, some of our consumer goods companies. But the positive here ties to inflation, which you noted, which is rental housing's definitely coming down. It's lags in the government's data. We see also input costs flat. We see the labor market not nearly as tight. And that's going to give the Fed some room here to cut rates. And when they cut rates, that's super helpful for the deal business as cost of capital comes down. So that optimism you heard from us was we were starting to invest in scale before the all clear sign. We deployed more than $50 billion in the second quarter, deployed or committed, and we want to do that before everybody says things are safe. And that's what you've got to do as an investor.
Well, that was a two-year high for you guys in terms of what you were actually deploying during that quarter. And so you do anticipate that level will continue given what, that you're have more confidence now because your expectations are that rates are coming down?
I think what you're seeing is as cost of capital comes down, it will enable companies to borrow more at lower cost. That's supportive for the transaction environment. It's supportive for asset prices, right? I mean, you PV, the cash flows out there. It's helpful for real estate. It's helpful for infrastructure. It's helpful for all sorts of companies. And so what we're doing is saying, look, people are still a bit cautious. Assets are priced at reasonable levels in the private markets. Let's try to take advantage of that. Yeah. We bought businesses around the world. We bought some fast food businesses, some technology companies at much more reasonable prices than 2021. And certainly in specific areas, there's a lot of opportunity. I would say the data center space is probably the area we've been the most active.
And I want to talk to you quite a bit about that. But I want to come to private equity for a minute because, frankly, between private credit and data centers and infrastructure and so many other things at Blackstone, we really don't talk about it very often. What about the exit side? We haven't seen many IPOs. It's been a difficult time to monetize some of these investments in the funds. Do you expect that things are going to open up there? And until they do, can you really put a lot more capital to work?
Well, it's a natural cycle. If you think about what happened, the Fed raises rates by 550 basis points, and it really stops the deal business, right? M&A activity falls off a cliff. There is no IPO activity, and you have a lot less realizations. Now we've seen the 10-year start to move down. The Fed here fairly soon will probably cut rates. Spreads are also coming in. You've seen investment grade, now non-investment grade spreads tighten. You've seen real estate borrowing costs come down. That starts to get that flywheel starting. We're a big investor in other people's funds in our secondaries business. We're the largest investor in that space. In the second quarter, we saw a 30% increase in realizations over last year. So we're rebuilding, but it takes some time. And as investors, what we're not going to do is wait for that all clear moment. We're going to deploy some capital first, and that's what you see. And then as we move into 25, that's when I'd expect to see a meaningful pickup in realizations.
Now, I want to go, and I know Dave wants to too, and Carl, your data's $25 billion empire, power-hungry data centers. I met the CEO of QTS. Thank you so much for introducing me. And when I came back and said, this is the company that has a vision. You're not trying to put them up and think maybe someone's interested. There's a real demand right now. You seem to be a real believer in what AI can do, and that may be you're involved technically with AI and data centers. So tell us what the big guys are saying to you. What's your relationship with Jensen Huang?
Well, I would say this. We have very good relations with the big tech companies overall, and we spend a lot of time talking with them. And I know there's a lot of debate about the amount of investment they're making today. What I would say is they see a huge opportunity here from AI, but it's also cloud migration, it's data storage. Right. And what the data centers are really the highway system of the 21st century.
But we have a bad highway.
Yeah, but this highway is going to get built out, and there's going to be enormous spend. And if you looked at the earnings calls, and this is what we hear not on the earnings calls and private conversations, they're saying, look, we've got to spend more. There's a greater risk that we're going to fall behind. And so what we're doing is taking their demand signals and doing it in the form of long-term contractual leases. And QTS has done an amazing job. It's been hugely beneficial to our real estate and infrastructure investors. We partnered with other companies in the
like
space.
CoreWeave, you just financed $4.5 billion, a $7.5 billion raise for them as well.
CoreWeave's an amazing company. We did our largest.
Tell them it's supplier to NVIDIA. Can we give a little context?
What they do is assemble NVIDIA chips. They put those together. This company's basically started as a crypto miner three or four years ago. They pivoted, and now they're this incredibly fast-growing company. They're using capital.